Hello everyone. Today we are looking at the financial heart of risk management, expected monetary value or EMV. Formally, this is a statistical concept that calculates the average outcome when the future includes scenarios that may or may not happen by multiplying the value of each possible outcome by its probability of occurrence. In plain English, this is the risk price tag. It helps us put a dollar value on a maybe. Stay with me here because you've probably seen this at the office where people say things like, we might lose money if the vendor is late, but they never say exactly how much that might is worth. EMV gives us that answer. I remember a project where we had a risk of a $10,000 fine, but there was only a 10% chance of it happening. The price tag for that risk isn't $10,000, it's actually just $1,000. By using EMV, you stop overreacting to every scary number and start seeing the mathematical reality of your project. So now that we have mastered the idea that EMV is the average cost of a risk, you might be wondering how we actually do the math to find that number. Well, that brings us right into our next step, which is the basic EMV formula. This brings us to the basic EMV formula. The technical books define this as EMV equals to P times I doll, where P is the probability of the risk occurring and I is the impact or monetary value of that occurrence. To put it simply, it's just likelihood times cost. Let's break this down together with a few simple examples. Imagine you are running an outdoor event. There's a 20% chance of rain, and if it rains, you lose $500 in ticket sales. 20 times 500 equals an EMV of $100. Or think about a server upgrade. There is a 5% chance the system crashes, costing you $2,000 in lost productivity. 5 times 2000 gives you an EMV of $100. Even though the situations are totally different, the risk weight is the same. I once worked on a project where we calculated the EMV for 20 different risks and realized that 3 tiny, highly likely risks actually cost us more than one giant 1 in a million disaster. By calculating these individual scores, you identify the real financial quote-unquote leaks in your budget. Now, while calculating one risk is easy, we need to understand how to handle the quote-unquote good risks alongside the quote-unquote bad ones, which leads us straight into the world of threats versus opportunities. Now we have to tackle EMV for threats and opportunities. Formally, EMV is expressed as a positive value for opportunities, which are risks that have a positive impact, and a negative value for threats. In everyday speak, this is adding the gains and subtracting the pains. Risks aren't always bad. Let's use some simple dummy stories. A threat might be a 30% chance of a $1,000 repair. That's a negative $300 EMV. But an opportunity might be a 10% chance that you finish early and get a $5,000 bonus. That's a positive $500 EMV. When you look at them together, your project is actually $200 ahead in terms of risk value. I remember a project where the sponsor was so focused on the threats that they missed a huge opportunity that was statistically more likely to happen. By using both positive and negative numbers, you create a balanced view of the project's health. But here is the catch. How do we combine all these different pluses and minuses into one final number for the whole project? That brings us right into our next step, total project EMV. This brings us to total project EMV and risk exposure. The book style definition refers to the sum of all EMV values for all identified risks, providing a single numerical value that represents the overall risk exposure of the project. To translate that into human speak, it's the project's risk total. You simply add up all your negative threat values and all your positive opportunity values. The number you get at the end is what the project is expected to cost in terms of uncertainty. You've probably seen this. A project looks like it's on budget, but once you add the total EMV, you realize you are actually exposed to an extra $50,000 in potential costs. As risk management professionals, we use this total to show the sponsor the true price of the project. By finding this total, you identify the risk gap in your funding. Now, once we have this total exposure number, we need a way to help the bosses choose between two different paths, which leads us to decision tree analysis. Let's look at decision tree analysis using EMV. Technically, this is a diagramming and calculation technique for evaluating several alternatives under uncertainty by calculating the EMV of each available path. In simple terms, this is mapping your choices. Imagine you have two choices for a vendor. Vendor A is cheap but has a high chance of a delay. Vendor B is expensive but very reliable. You draw out the branches of your tree, calculate the EMV for each path, and the math tells you which choice is statistically smarter. I remember a project where we had to decide whether to build a new feature ourselves or buy it from a third party. The buy option felt expensive, but the decision tree showed that the build option had so many hidden risks that its EMV was actually $20,000 higher. By using trees, you help your stakeholders make decisions based on logic instead of fear. Now, while having these calculated paths is a massive win, we need to turn this data into a specific request for money, which brings us right into our final step. Finally, we reach the calculation of contingency reserves. The formal definition is the process of using the total EMV to determine the amount of funds or time needed above the estimate to reduce the risk of overruns of project objectives to a level acceptable to the organization. In plain English, this is buying your insurance. You take that total EMV number we found and you say to the sponsor, based on our math, we need to put exactly $15,000 into a piggy bank just in case these risks happen. Stay with me here because this is the mark of a pro. You aren't just asking for a 10% buffer because that's what everyone does. You are asking for a specific amount backed by statistical proof. It's been a long journey from our price tag to this high discipline system of financial protection. This systematic approach ensures that your stakeholder engagement is professional, data-driven, and builds massive trust with your leadership. So now that we've mastered the power of EMV calculations, well, that brings us right into our next chapter.